Everyone, even though I haven't been telling you I'm Cliff DeWitt every time, just to be not so repetitive, I still am. So, on this particular recording, we're going to be talking a little bit more about international trade. Now, up to this point on Chapter 15, we have been talking about the reasons for international trade, which basically involves comparative advantage that countries will send out or export things that they can make at low cost, low opportunity cost, and the receiving country will receive the goods produced by the country with competitive advantage at a lower price than they can produce it themselves. And so they also have something that they can produce at low opportunity cost, and they will sell it to other countries that don't have that capacity. So international trade benefits everybody. Now, we also talked about trade barriers, how international trade essentially, even though it's not good for everybody at all times, in the long run, it's much more beneficial than not having international trade. And so economists tend to favor removing barriers of it. The other thing we talked about is how international trade affects the aggregate demand of the United States, whether it's if you're at a deficit or which we have been in the United States for quite a while, or a surplus. So we're going to talk a little bit more about the financing of it and what are some of the peripheral things about international trade and how to account for it. Now, first of all, as we know, international trade is not bartering. It's not like going to the Safeway store and buying a bag of corn nuts, where you just grab the stuff, pay the money, and you're gone. International trade is more complicated than that. We know that sellers of domestically produced goods want to be paid in their own currency. Okay. The buyers, a foreign buyer of the domestically produced goods, generally do not start out having the seller's currency. So they have to go to the international exchange market, which we'll be talking about in the next recording, and get enough of the selling country's currency, buy enough of that, to buy the goods and services and pay the other costs involved. And there are other costs involved. There's costs dealing with possibly paying rents to foreign owners of factors of production that we will use, say, but we don't own. There's other administrative costs in dealing with international trade, things like that. Okay, so there's much more involved, and it's a little more complicated. So first of all, we do see that the buyer exchanges their own currency for the currency of the selling firm. So let's consider us in the U.S. Basically from the perspective of the buying firm here. Okay. Now, there's a number of things that has to be paid in an international transaction. It's not just, as I say, the currency for goods and services. There's payments to owners of the factors, rent. There's payments for other things. There's transfer payments, that we'll talk about that in a bit. There's also another form of payments that goes out to foreign countries that don't have directly to deal with international trading, but it shows the level of whether we have a deficit or a surplus in international trading, and that's buying assets from other countries that are owned in other countries, or foreign buyers buying assets owned by us in the United States. Now, there's two different ways of accounting for this. First of all, we have what's called invisible ink. We have what's called, hopefully, the current account. Okay? Okay. Now, the current account, it has transactions. It's a total of transactions that basically measure the money going out or coming in, as opposed to less money going out. Okay? So, of course, when the money coming in is more than the money going out, the current account is said to have a surplus of the balance of payments. Now, the balance of payments refers to the balance of the current account. And the current account talks about things that are current, obviously. It talks about trade, money for trade, money for income, like from interest, rents. It talks about that, yeah. And transfer payments. Transfer payments in the current account in international trade are the same, defined the same way as they are in domestic economics there. It's basically a payment that is given a nation instead of us old fogies whose 40 years of working didn't mean anything. But they're payments that are given, value incurring to a government or a country that no particular similarly valid work or valued work or service is provided. Okay, some of the things transfer payments that would be included in this would be things like foreign aid. It would also include things like buying fixed assets, okay, and other things like that, okay. Now, also we have, on the other hand, and let's see how our time is. We're doing all right. Okay, the other type of account we have is called the capital account. Okay, the capital account. The capital account deals with things that have an impact upon future earnings and future production. That's pretty much in line with the definition that we have in capital, basically in economics, of things that make other things. Now, basically the capital account are assets. Purchases of assets, and other things like that. And the capital account is measured by basically the capital account equals the U.S. assets purchased by foreigners minus the foreign assets purchased by the U.S. Okay? Get that? The current account balance equals all money involved with trade coming in minus money going out. If that's positive, we have a surplus. If it's negative, we have a deficit. Capital account is the balance includes foreign purchase of U.S. assets minus foreign assets purchased by the U.S. Okay? Get that? Now, the most important thing here that we need to recognize and this is a little, when I first read this a number of years ago, I thought, this doesn't make sense. But it kind of does, okay? Now, of necessity, okay, the balance of payments refers to the capital account only, okay? When you hear balance of payments, that talks about the capital account. But what we have here, of necessity, the current account, see if I can, okay. The current account plus the capital account, by definition, added up equals 0. Okay, they cancel each other out. So what does that mean? Well, obviously, one has to be negative and one has to be positive, or the other way around. So if there is a surplus in the current account, which means that there would be, generally means there is a trade surplus, there would have to be a deficit in the capital account, okay? So if a trade surplus, that means that foreign buyers, are buying more of their stuff than we are buying of theirs. You know, because, so the current account balance really is exports minus imports, okay? Exports minus imports plus we have the foreign purchase of U.S. Well, I don't think I wrote that. Better be consistent writing it here. So we have U.S. assets purchased by foreign buyers minus foreign assets purchased by U.S. buyers. Okay? So this plus this has to equal 0. So just very simple algebra. This equals, the current account equals -1 times this account. Minus F US. Okay. Now what does that mean? You know, what's the rationale in that? Well, if there is a trading deficit, that's not necessarily a bad thing, because that means the dollar is weak and U.S. assets are attractive to foreign buyers, and more assets are coming in the payment of money by foreigners, and that means more foreign ownership of U.S. assets. But that's not a bad deal. And we'll continue on with that in the next recording. Thank you.